So where do we go from here? Well, we'll see as we run down the answer that the key point in relation to the two different gains, one eligible, one not, is columns. We've got three columns here. Now, do you need the third one? Well, I would incline to put it in because we could have more than one gain. More than two. So I'm inclined to put it in just for the sake of completeness so I can sort of cross-cast, okay? So first things first, and the obvious element here is the eligible gain. I'll look at the working in a minute, but stands on its own, okay? Because we know that this is going to attract certainly a rate of 10% because it's BADR savvy, BADR eligible. I'll go through the conditions in a moment. So own column, yeah? Now, let's look at the other gain, I think an investment property, as we said. So they gave us the gain to make it easier for us. You know, we see that the annual exemption is deducted here, yeah? Now, I'm wondering why. Well, why is because this particular gain is going to attract a higher rate, as we'll see in a moment. So that makes sense, doesn't it? If you want to mitigate or reduce your overall liability, then certainly use your AE against any gains that are taxed at a higher rate. And really, that is, I guess, one of the key 2 or 3 points that the examiner is testing in this question, outside of conditions, etc. Okay? So there we have it then. We have taxable gains. The eligible gain slots in. The other gain after AE9 and the total, okay? The worst thing that we could do is put them all in one column, because then when we get to the taxable element, how do we apply different rates to different things? Or would we just apply one? There you have it. So as we move down the page, now this is a key point, and I think students find this a little bit confusing, okay? We know that the examiner has to supply us with either total or, in this case, taxable income, because income tax impacts upon CGT rates, okay? Now, given that, yeah, it's 30,000 in terms of the income, so we know that we have a balance of 7,700. 30 plus 7 is the basic rate band. Now, note, in relation to BADR, and this is the bit that I think students find a little bit tricky, yeah? Eligible gains, i.e. gains relevant to BADR, are first matched with unused basic rate band, yeah? In other words, where you have these significant gains, they use up the basic rate band, which basically pushes out any other gains, the investment property in this case, to a higher rate. Now, I went through that fairly quickly. If you're finding that confusing, I understand. But in essence, let's get back over the text and just look at the little nuances in relation to BADR. It uses up the gain. It uses up the basic rate band, which basically makes rates applicable to other gains higher. So here we see it in play. So 10%, 450, absolutely, yeah. Note, including the use of the basic rate band. So there's the tax element. And 20% on 9. Why? Because there's no basic rate band. It's been used up by this very large and significant eligible gain. Okay? So there's the tax. Now let's take a quick look at the working. Reasonably straightforward, to be honest. You know, we basically got a three-liner, yeah? Market value less cost equals 450. Now, this is well below the limit, and remember, there were no other relevant BADR disposals as mentioned within the question, so we're good. So what about the conditions, etc.? Okay, well, bottom line is that it's a freehold property, yeah, and note this was a ceasing business. He had owned the asset, this qualifying asset, for the 2 years, ending on the date of sale or date of cessation, in effect. And indeed, yeah, the building was actually sold within 3 years following the date of cessation. Okay, so this is, you know, a sort of a little side area, isn't it, of BADR, where you've got a business ceasing and indeed an asset being sold. Now, again, as I've said within all reliefs, and you're sick of listening to me, we've got to rote learn the conditions. That's our first port of call. You know, understanding the questions and the answers comes with a little bit of time. Okay? So in effect here, and in summary, what we had, if I go back to the scenario, is a situation where we see a business owner, ceasing in trade and indeed selling an asset. It looked like the conditions were in play, you know, trading business, time limits, etc., etc. In addition to that, we had an additional asset, okay? The examiner wanted you to put them in the same column and tax maybe at one rate. We didn't do that. We separated them out. In essence, we had 3 columns, okay? Then we saw that the BADR used up the basic rate band. So in terms of the rate applicable to the other gain, it had to be 20%, not 10, okay? The mistake that students would make is say, well, there's 7,700 of the basic rate band available. I can apply 10% to that. No, 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 definitely not, because BADR uses up the basic rate band. Okay, so I hope that made sense. Quite a lot in there. If you're confused, then welcome to the world of TX. Don't worry about it. Let's do the question.